just the simple fact of applying the proper weighting scheme to the exact same positions in your portfolio is about 13% in performance. That's a lot.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Okay, welcome to this episode of The Bull of Wall Street. My name's Talley and I'm the Chief Market Strategist at the Wealth Consulting Group. And I'm joined by my co-host there, Jim Worden, our CIO. And we're super excited this time because we have a technical vibe sesh with none other than Julius de Kempenaer, creator of relative rotation graphs. Welcome to the show, Julius.
Thank you, guys. It's great to be here.
Awesome. Where are you based, Julius? Is it the Netherlands?
I am in the Netherlands. I say in Amsterdam, but technically it's about 45 minutes to an hour, depending on traffic, south of Amsterdam. So
that's great. And we like to lead in with things that our advisor audience may not necessarily know about you. But is it true that you were a captain in the Dutch Air Force?
That is true. Yeah, I have to admit to that fact. I actually, after high school, I went to the military academy as an Air Force cadet. And then after that, I served another 4 years as an officer in the Air Force, and I retired as a captain. As a matter of fact, I actually got a letter a couple of weeks ago, and it was addressed to Major de Kempenaer. And I guess because when you leave the Air Force, you become a reserve, and then blah, blah, blah. And then after so many years. So I guess technically I'm now a major, where I used to be, because actually yesterday, I went to a retirement reception of one of my classmates. So that's, our class is now ready to retire from active service.
Wow. That's impressive, Julius.
It's very cool.
Yep. And I didn't make it that long.
Well, we're thankful because it took you to other things, and we're big users of your framework. But I have to admit, I do kind of follow you. I'm a bit of a stalker online, and I saw that we actually hang out with some of the same people in the technical realm. But is it true that you just completed your CMT after all these years?
Yeah, that is true. Yeah, there's a bit of a story there. I passed when I just started, so I left the Air Force, and then I went to Robeco. So first to AXA, Equity and Law. I was working as a fund manager. And then I was already working with technicals and quant stuff. And then I got an offer from Robeco to become a full-time technical analyst on the buy side. That's cool. I can do what I like all day long. So that's what I did. I moved there, and then the MTA at the time I got in touch with MTA, and I thought, that certification, that looks cool. And so I started on the program, and I passed my CMT level 1 in 1995. Then I failed my level 2, obviously for all the wrong reasons. And I did not agree, but hey, what can you do? And then I took it again in 1997. So I passed my level 2 in 1997. And at that time, you had to complete all 3 within 5 years to get the charter. And I was already 3 years in, and, work, life, family got in the way. So once the 5-year mark passed, which was in 2000, it was like, all right, that was it. I'm not going to do 1 and 2 again. That's not going to happen. So I left it there. And then I a couple of years before now, the CMTA then they changed the rules, so the 5-year was off the table, and also at that time you had to write a thesis. So your level 3 was not what it is right now. It was you had to write a thesis, and people would look at it and say like, oh, this is okay, and you are now a CMT charter holder. And then they got the new formula. So the system, like the way level 3 is now administered. And it was like a lot of questions and open and multiple choice. And I was like, oh my God, do I really have to study all that and do all that stuff? It's been so long and felt like I had to do it all over again. So I kind of never did it. And then last year, January, I was at the CMT event in Tampa. And during one of the breaks, I was speaking with Tyler Wood, the executive director of the CMTA, and Eugene Sorensen. And the conversation came onto the CMT and the charter and blah, blah, blah. And he said, both you guys, you're not CMTs. I said, no, that's right. So I told him 95, 97. And Eugene, apparently, I didn't know at the time, was in the same boat. He also had level 1 and 2 and never purchased level or progressed to level 3. And then Tyler started like, guys, it's never too late and blah, blah, blah. So we left the conversation there. And then like 10, 15 minutes later, after the break, Tyler goes on stage and does a pitch for the CMT program. And he's like, you can do that and blah, blah, blah. And it's never too late. He goes, these two guys in the audience there, Julius and Eugene, it's perfectly fine for you to take the exam. And Eugene and I were looking at each other like, oh my God, this is not going very well. So that happened. And then, so that was in January. And I think the exam was in June and you had to register before, I think April or May. So somewhere mid-April, I got a text from Eugene. He's like, the registration for the exams is now open. What do you think? I go back, I think we have to do it. It's a good thing. So we signed up and we promised each other to study very, very hard and catch up every week to do it, which never happened. So, and then, come the day of the exam, I was like, oh my God, what's going to happen here? I'm going to fail this so miserably and I'm just going to, rely on my experience and my thing. So, and I promised myself, so I go in now. If I fail, I will do the study and I will pursue it. But we'll see what happens. So I went in there. And when I came out, I was absolutely convinced that I failed. It's like, this is no way that I passed this. And then, 8 weeks later, so they got, you got to pass. It's like, okay, that's fine. I'll take it. So after almost 30 years, I am now a CMT. True.
Congratulations.
Wow.
I think that's a great story. Tyler has actually been messaging me, so we have to compare notes, Julius. It's peer pressure, so I'm feeling it too here.
And I told Talley, I said, because Talley is really into charts. I did my CMT. I got it in 2016. I told Talley, I said, you got to get it. Mm-hmm. It's worth it. So I felt the same way, by the way, Julius. I did the CFA. And it took me a little longer than most to get it done. That. Yeah. But you do feel that way. You feel like, oh no, I didn't make it, right? And then
true.
And then you have to for CFA, you have to wait like 2 months or 2.5 months, and then you get it, and you're like, oh wow, I made it. Yeah, so celebrate.
Exactly. Yeah.
Well, so I have a kind of similar story to tell. This is really how, Julius, you and I connected. But back in August, this does a couple things for us on the episode here. But I did a TV segment with Charles Payne. It was Making Money. And he surprised me because this was live and unrehearsed. But he had a touchscreen of your RRG where we mapped this kind of budding risk-off rotation out of tech, at least tactically, and into defenses like healthcare. So first, let me just say, that's how useful your framework is, because that's pretty much exactly how things developed and evolved into December here. But second, you actually caught the segment and pinged me and agreed to come on our show. So thanks on both counts.
Yeah, it's the way that happens is I have one of these Google search things. So whenever RRG or relative rotation graphs are mentioned in major news things, I get a little message. So I'm like, oh, look at that. And I saw that. I was like, oh, that's cool. So I sent you a message like, thank you.
I learned it pretty well because that was off the cuff. But maybe just because you touched on it there, Julius, for our advisor audience, could you give us a little primer on your RRG and what it is and how they can use it?
Yeah, so RRG stands for relative rotation graphs, and that is basically it's a visualization method, a data visualization tool that helps investors, traders, RIAs, anyone who's interested in the markets to visualize. We call it sector rotation, but it actually shows like any rotation in financial markets. And the added value is that when you do traditional relative strength analysis, it's always a one-on-one comparison. You can look at the sector versus the S&P. You can look at a stock versus its sector, but it's always a one-on-one comparison, and it'll tell you whether that sector is doing well or is not so well, is outperforming or underperforming. And an RRG allows you to see all of those relationships in one graph. And that is the added value. You get a complete picture of, if we stick with sector rotation, you can get a complete picture of what's happening among it's now 11, it used to be 10 sectors in the S&P 500. And as you said, Talley, it's like you can see if a sector is rotating into favor or out of favor. Yep. And over the years, I learned a lot in terms of how rotation works. And there's so much more things I know about rotation now compared to, 2011, they were launched on Bloomberg, but they were actually already in my toolkit since the mid 2000s. And over time it developed, and by working with it, you learn a lot of stuff and you see a lot of stuff. And the segment that you were talking about was one of the good examples. One of the things that I learned is that when the market still goes higher and continues higher, but you see a rotation out of like growth sectors like tech and consumer discretionary, and to a lesser degree communication services, and you'll see improvement in utilities and staples and in healthcare. That is, for me, that is a big warning sign. I've seen it a few times before now. The market is still carrying on. Everybody's bullish. And then you see under the hood, you see people moving out of the growth stuff into more defensive sectors. That is one of the things that you can pick up by using an RRG. So it helps you to, get an early warning signal, get a complete picture of the landscape that you're working with. And again, we're talking about sectors here, but you can do the same with individual stocks versus a sector index. I use it for growth and value, and even for mid cap, small cap, large cap, or the cross section of those two. You can use it for fixed income. I use it with fixed income ETFs to analyze the yield curve in the US. You can see if it's flattening or steepening, and whether it's going up or down. You can use it for currencies, cryptos. I'm not sure if you guys are interested in that, maybe the audience, but it works for cryptos as well. Asset classes, very important. If you start at a very high level, you can look at. I very often use an asset class RRG using stocks, government bonds, high yield bonds, corporate bonds, commodities, and then I use Bitcoin as a proxy for the entire crypto space. Yeah. You could stick in a crypto index or whatever, but it's just like that very high level, and you peel down and you get more layers of your portfolio. That how granular that you want to go, you can use it for that.
So how about now? And I would just preface this by saying Jim and I are happily, obnoxiously bullish because we feel like the risk off rotation is pretty advanced at this stage, and we're kind of we've been shopping the sales and the cyclicals, kind of back in this risk on by the dips mode. But how about you? What are the stock charts telling you right here, right now?
Well, I mean, if I look at there's one thing what's very important in RSG is the time frame. So just like a normal chart, if you look at a weekly or a monthly chart, you got obviously way longer time frames than when you look at a daily or an hourly chart. So my go-to time frame is the weekly RRG, is a weekly chart compared with a weekly bar chart. That's just basically because of my background with institutions. They don't really like to switch in and out of whatever 2 days after they entered. So that is my go-to time frame. And the rule of thumb that I kind of use is when something changes, when a real trend change occurs, I keep as a rule of thumb that trend change should persist a minimum of 3 months, and very often much longer. But that's kind of the rule of thumb. Like, it's not, if you on a weekly RRG you see something happening, then it's very unlikely that it'll turn around a month later or 3 weeks later. That's very unusual. You will see much longer trends evolving after that happens. So when I look at an RRG right now, I opened it up right next to me to make sure that I say the right things. I'm still a bit more cautious, I guess. And the reason is that the technology sector is still on the right-hand side of the graph, and the right-hand side is positive, the left-hand side is negative. And we know the leading quadrant, that means that the relative trend is up, and that is still being pushed higher by strong momentum. So tech is now inside weakening, which means that the relative trend is still up, but is losing momentum. And sectors that are already inside the lagging quadrant are consumer discretionary and communication services. And they are still what I call at a negative heading, which means that they continue to lose on both scales. If you look at industrials, financials, materials, they're inside lagging, but they have rolled back up. But more important, going back to the discussion that we had prior, healthcare and utilities are now inside the leading quadrant, and staples is in improving at a positive heading. So I'm a bit, I don't know, on the edge, because what you would usually see is that staples, healthcare, and utilities would move as a cluster. They would move together. And what we see now is that healthcare and utilities are kind of in that positive trend, and staples is only now catching up. It's the lowest ranked sector on the weekly RRG, which is very unusual. Well, it's very unusual when healthcare and utilities are so way ahead. So that is kind of confusing, maybe. I don't know. It's out of the ordinary. But it's also out of the ordinary that tech is so far on the right and everything else is on the left. Basically tells you something about the weight and the importance of that sector.
That's right.
If you get tech right, you got the market right. That's exactly pretty much what it tells you.
Yeah, it's such a polarized market. But let me bring Jim in here, because he's the one that really got me onto the JDK RRG, and we use it as a tool in our kit on the WCG ISC. But Jim, jump in here.
Yeah, so this is really a wonderful conversation, by the way. And so, like, we use it. We have some models that will look at the momentum, and I know there's some people that look at the direction, right? But I love what you said about broad asset classes. So sometimes as a committee, we'll look at it. We have everything in there. We got like long bonds, we got gold, we got Bitcoin. And we by the way, we've given a nickname for the lower left quadrant. We just call that the doghouse. sometimes it's like in the very, very far, very, very bottom corner. And that's really in the doghouse. This is, a year ago or so, we had energy was down there, and then energy was, in 2022, it was doing well, and everything else was kind of in the doghouse. But I wanted to ask you, so we do the same thing. We use 12 weeks. When you look at these things, do you say, okay, so the momentum is fading, I'm going to hold on to it, but when it crosses below that line, I'm going to start fading my exposure? Or do you wait until it gets all the way in the doghouse? I'm just curious what. how to look at it.
That's where a bit of subjectivity comes in. There are definitely ways that you can use RRGs on a more quantitative way. If you just use the visualization, then so an RRG always rotates clockwise by definition, but it does not always rotate through all 4 quadrants sequentially.
Yeah.
What can happen is that in the case, if we stay on the right-hand side, for a very strong sector, which is in a very strong relative uptrend, trends, even relative trends, are never a straight line. They are a series of higher highs and higher lows.
Yeah.
And when you see something that's in leading, rolls over, drops into weakening, and then comes back up and starts to move back to and into leading again, that's where you have that high-low rotation within an uptrend. And it's actually interesting because those are the most reliable moves on an RRG. Because
interesting.
When you move from improving to leading, that's actually a trend change. You go from the left-hand side, which is the relative downtrend, to the right-hand side, which is the relative uptrend. And obviously that move is the riskiest one because that is a trend change. And, it takes a little bit of time before you can confirm that trend really has changed. So when you see leading, weakening, and then starting to roll back up again, for me, that is the sign that a new up lag in an already existing relative uptrend is starting. So you're embarking or re-embarking or getting back into an already existing trend, which is obviously a lot less risky than trying to catch the trend change. Now, in my presentations, I have a couple of sheets that I use to sort of give like rules of thumb for the interpretation. And what I explain to people is when I first had an RRG in a very early fashion on my screen, I thought like, oh, this is cool. This is easy. When it moves from improving to leading, that's when you buy. And when it moves from weakening to lagging, that's when you sell. Well, that was the theory. Unfortunately, the practice was a little different. And what I've learned is that because it's the way the calculations are done, there is a time element and a time lag in there. Otherwise, it'll jump all over the place.
Sure.
And what it means is that before you actually cross over, already a lot has happened in terms of price and relative. So you're quite late to the game. So then I thought, you know what? We'll do it the other way around. When lagging to improving, that's a buy signal. When you go leading to weakening, that's a sell signal. But what happens there is that you're earlier to the game, but it's also riskier because you could end up buying something that moves from lagging into improving, but then does the same on the other side where it rolls from improving back to lagging and you're back in the doghouse. So you got to be prepared to get out of that position. You can be very early into the game, and if it works and it rotates all the way through, great. But there is a serious risk of it to roll over back to lagging. And what I have learned is like the farther away you are from 100, so the higher or the lower of the RS ratio scale, the more risk you have or benefit if it's on the right-hand side, that it makes that complete rotation on one side. So you're actually in a very strong trend. There's no right or wrong answer to the question when you do it. Everybody uses it differently. I like it when something is for a buying perspective, when something's inside the improving quadrant with good momentum and showing what we call a positive heading, which means that if you compare it on a compass between 0 and 90 degrees. And then, obviously the closer to the leading quadrant, to the 100 level, the more reliable that gets. And what also helps is looking at the tail length. So the longer the tail length tells you something about the power behind the move. So the longer the tail, the more power behind the move, and the higher the odds that it's actually will continue that move.
I'm glad you mentioned the tail because we look at that too. And sometimes they don't move that much, right? And so I think there was a period, maybe it was last year, the year before, financials and maybe some sectors don't move as others, but it just kind of stayed in the same place.
Yeah.
And you have to kind of look at it and say, well, where it looks like it's improving, but it's very slow.
Yeah. So the way I learned what it works is when you have a long tail, there's power, there's momentum behind the movements moving. When you have a very short tail, and for example, I'm looking now, like XLF is a good example. It's inside the lagging quadrant, pretty close to 100, but it's got a very short tail. Mm-hmm. By the way, if you look at an RRG with a specific setting for the tail length, that tail length, by the way, is only for the view. It doesn't change anything of the position. It just shows you more history. Sure. And so all the tails are always in equal length in terms of time. So if you do five weeks, all tails will show 5 weeks of data. But the one is much longer than the other one. So if you look now, XLV healthcare is actually is the longest tail, moving from improving into leading. It's powering ahead. It's the strongest sector in the market right now. If you look at XLF, it's inside lagging, and the tail is short. It's minimum, and it's like static on that position. And what that means is that it is in a relative downtrend, and I call that a very stable relative downtrend because it's sticking almost on that same position. It's like it's rotating on that same spot, which means downtrend because you're below 100 on the RS ratio scale. And you've got a little bit of negative momentum. So that trend just continues to move lower and lower and lower and lower and lower. The doghouse, something you really don't want to be in right now. Yeah.
That's interesting. And I feel like a lot of these, like you said, with the time, because I've looked at it over longer periods, the analytical person that I am, like, well, what if I go out like 6 months? Or then it becomes spaghetti, right? Because you got different colored spaghetti.
Yeah. So you mean when
long, right?
When you set the tail length longer?
Yeah.
You mean the setting of the tail length?
Yeah, the tail when the tail is too long.
Yeah, I always tell people, the tail length is just for the visualization. And I always, what kind of tail length should I use? People ask. So, well, depends a little bit. If you have only a few securities on the plot, you can use a longer tail length because they will still be visible. If you load up all 50 or 70 technology stocks in the tech sector, you don't want a 10-day or a 10-week tail because it becomes spaghetti. So then you'll make it a little bit shorter. But then you can scroll through time. So you can still, when you put the slider in stock charts or an Optima or Bloomberg doesn't have that. We're working with them to get that there as well. But you can then slide through time, and you can see actually the rotation becomes alive and interactive. Yeah, absolutely.
So let me ask you about that. I mean, have you done any research just over time to see, are there patterns where, and maybe it's not one of those rules of thumb that happens all the time, because like you said, with utilities and staples, normally they would move together, but like, can you look at those way back in history and see like these things tend to move together most often and others don't?
I spent countless hours looking at that and scrolling through history. And then you find it's I guess it's the same with every pattern that you see on a chart.
Yeah.
You see something and then you go back in history. How often did this happen?
Yeah.
But it's hard to quantify.
Sure.
Maybe with AI nowadays, it would be some possibility.
Yeah.
I don't know, because it can process a lot of data a lot faster than we can. I've done a lot of testing. I mean, first of all, people ask me like, what are the trading rules for an RRG? I was like, well, there are no real trading rules. It depends on your horizon, depends on your universe, depends on your risk appetite. And then I ask, so what are the trading rules for a bar chart? Or what are your trading rules for a candlestick chart?
Yeah.
Somebody likes to trade a 20-day breakout. Somebody else likes to trade a 5-day breakout.
Yeah.
If you work with moving average, someone used a 5-day moving average. The other one uses a 50-day moving average. it's very hard to come up with a very specific rule set. Now, having said that, because I wanted to be able to answer that question, so the what I just explained from the going back, like leading, weakening, back to leading, that came from a test that we did with Optima software. Allows us to make those calls in script, like what if, this, and you describe a pattern, and then and then it goes, it comes back with this happened so many times in the past, and 3 weeks, 6 weeks later, the return was this, and you get all the stats. And so I started, one of the things that I started to work on is the RRG heading. And then basically when you move into that 0 to 90 degrees. So the previous period, the tail is outside of 0 to 90 degree. And then when it turns into 0 to 90 degree, what happens? And what you see is that it happens most often inside the lagging quadrant. Well, no surprise there, because the thing is in a downturn, and it has to start rolling up at some stage.
It's going to bottom at some point, get some support.
Exactly.
Mean reversion.
Exactly. Yeah. So so that's a good thing. And what we also learned is that it happens the least in leading. It happens sometimes in improving, and it also happens a good amount of time inside weakening. And when you start doing the comparison, so if it happens in one of those quadrants, what are the results? The problem was when it happens inside lagging and the heading is the only thing you look at, you get caught in those lagging, improving, lagging rotations. So you're basically you're catching a falling knife.
Yeah, a falling.
You buy it bounces up a little bit.
Yeah,
and then it turns down, and the knife, basically
like the failed breakout. Like you think it's going to break out, you think the trend's going to reverse, and it kind of does a little bit, and then it comes right back down.
Exactly. So if there's people who use that, but you got to be prepared to have a very short stop loss and basically admit that you're wrong. If you're right, it's probably one of the best moves you can get.
Yeah.
Question is how, everybody's different. People are maybe not prepared to take that risk. What we learned there is that the best ones are lagging, leading, weakening, leading. What we just explained, because the trend has already changed, and you're picking it up when it starts a new lag in an already existing trend. Same goes, by the way, on the other end when you do the lagging, improving, and then back to lagging. So when something is inside improving, it rolls over and starts to head at a negative heading. That's a very reliable, if you want to go short or underweight or whatever, signal.
Well, I must say, Julius, this has been really fantastic to have you on. You're like a legend. And so I have like one of my CMT books. This is a level 3. Maybe I can just show the camera how thick this is.
Stage prop.
It is thick.
I know. And so they have a whole chapter that's you in here. It's chapter 20.
Yeah, I know. I wrote it myself.
You wrote it. I know you wrote. Everything is relative strength, and relative strength is everything. So I feel like that's a good, simple way to explain to people that things move. And sometimes maybe the benchmark we use is not always the most appropriate one. Sometimes we get fixated on the S&P 500. We need to look a little bit more broadly. But I feel like that's really how things work with trend and momentum, right? So things get stronger and other things get weaker at the same time. And then there's the, how fast it gets stronger or weaker, right?
Yeah.
The momentum.
Yeah. And you touch on the benchmark. That's probably one of the most important things that you use on an RRG. I mean, the benchmark dictates how the RRG looks. So I've done a ton of work on that. And one of the things, because so Stock Charts has a lot of retail users. And I always tell people, I come from the institutional world. Institutions are relatively simple to deal with because they are relative. Yeah, that manager needs to beat the S&P 500, or he needs the tech sector needs to beat Russell, whatever his benchmark is. So that is very clear. So when the market goes down 10, when the market goes down 5, when the market goes down 10 and he goes down 5%, He's a hero because he outperformed the market by 5%.
Sure.
Talk to a retail investor, they hate you because they lost 5% of their money.
Yeah.
So I came up with the concept like, all right, so retail investors, they want the best of both worlds. If the market goes down, they don't want to lose any money. If the market goes up, they want to beat the market. So I call that the God benchmark. And you can come up with different variations on that. But I have in my stock charts account a UDI, a user-defined index, which basically follows the S&P 500 as long as the S&P 500 is over its 50-day moving average. And then when it moves below its 50-day moving average, the benchmark goes flat, because then it becomes an absolute return. You don't want to lose any money.
Yeah.
So then it turns into, and you can use that so on stock charts, but also on Optima and other platforms. You said you use Bloomberg. You can use USD currency. USD currency is always one. Sure. If you stick in a currency which is always one, the RRG all of a sudden becomes a tool that looks at absolute price trends. So it's not relative anymore. Well, it's relative to 0 or 1.
Yeah.
But what it does to the composition of your RRG, think about it. When you set the benchmark to 1, usually take the Dow 30, take the 30 Dow stocks. If the Dow Jones is in an uptrend, the majority of those stocks will be inside that leading quadrant because that market's going up.
Sure.
And you will see them all moving in a pack together, which is very different from a relative version where you can see stocks underperforming and outperforming, etc., which was the original idea of an RRG. But over time, I found out like, hey, this is the way it works. When you look at absolute price trends, and then when you combine a retail investor and an institutional investor background, it's like, okay, so when it goes up, I want to beat the S&P. If it goes flat, I want to beat the 0 line. I just want to, make money, basically, just pick up price trends. For a retail investor, that's doable because he can just say, oh, I'm going to go all cash. If you're an institutional portfolio manager, that's much harder. That's not going to fly. So that's also another, use case for RRG, if you wish, that you can cater for those types of people.
It's interesting. We have some strategies that are tactical that will systematically move to cash, and so we call those the nervous Nelly clients, the clients that they know they need to be in equities, but like drawdowns, they have a really hard time just sticking with it. And so this model, and no models are perfect, right? But the idea is we're going to limit the risk, we're going to limit the drawdowns, downside, and then get back in when things kind of calm down. Yeah.
What happens? You will lose a little bit on the turn.
Yeah.
Because you're a little bit late, but that's the result of trend following strategy. I mean, we all know that, and if you're happy with that, then that's absolutely fine.
Yeah. The trend is your friend until at the end.
It is. Yes.
Julius, I got a question for you, kind of a broader conceptual one. What was the kind of aha moment or trigger when you created relative valuation graphs? And did you have like the foresight to expect it to be as widely used as it is now? And maybe talk about some of the resistance or the skepticism initially and what you did to overcome that.
Great question.
So there's a couple of questions. Let me start with how they came to life, because that didn't happen on Sunday afternoon at the kitchen table. This is a process that took some time. But it all started with as I said, when I was working on the buy side and on the sell side, and those fund managers asked me like, what are your best 5 sectors? What are your best 5 stocks? I thought I need a ranking system. I need to be able to answer that question, like, what are your best 5 sectors? So I started working with relative strength. I was already doing that. I was like, all right, this is the answer. We need to work on relative strength. but I need it to be comparative. And at that, the way comparative relative strength was mostly used was by basically anchoring a look back period. I think it was IBD did that. Like you had 12 months.
Oh, yeah.
And I 12 months ago, this was at 100 and it's now at 101. So now it has positive relative strength.
William O'Neill.
Yeah, exactly.
Yeah.
But if you look at the relative strength itself, I call that raw relative strength. Say a year back, maybe it's now just above, but maybe 6 months, it went down 6 months, and then it went up 6 months. And it could have been going down 50% for 6 months, and then 6 months up. So basically, you're already picking up 100%. And now you say that it's outperforming. Yeah, right. I mean, you missed the entire up move.
Yeah.
And we all know these relative strength charts, which anchor back, and then they show you the performance of the various sectors over time, and you can see which ones are above or below. But if you actually start to look at how the process and the path is, how they came there, it's very, very different. Some just dipped and they're all the way up, and some went up, and so I thought I need to find a way to pick up trends in every single. Again, it's all started with sectors, so I'm sticking with sectors, but it goes for everything you stick in there. I need to pick up those trend changes in relative strength to answer that question. What is the best? So I came up with a way to create that ranking, and that was the RS ratio. It was an early version of the RS ratio. And I used that in a table. I published my research with that table, and there was a ranking there. And then this is back in 2000 when the dot-com bubble happened. NASDAQ was at 5,000 and God knows what. Everything went through the roof. So my trend following strategies were like, that was technology was all the way up there and was very good. And then started to roll over and started to plummet. And obviously, the RS ratio that needed a little bit more time, before it actually started to show up in that line. And then I got an email from an Italian hedge fund manager, and he actually wrote like, "Hey, Julius, this time your system didn't work too well." Boom. Okay. He's right. You need to come up with something. So I was like, okay, so what do? I need an early warning system. So I started to play around with momentum and rate of change. And we all know that rate of change is is a leading indicator.
Yeah.
Because before a trend changes, the first thing that will happen is your rate of change will slow down, and then will turn around and will still pick up. So I started to measure the rate of change of my trends, and that became the RS momentum line. So from then on, I had two columns. I had my column with my RS ratio, and I had a column with the RS momentum. And I could actually plot them on a graph because, technicians like graphs. So we like to see how that happened in history. So I was using that. And then at some stage, I was just playing around with Excel and just, selecting columns and cells and looking at the various graph options. And I clicked on a scatter plot. And then all of a sudden, I get this plot with all these little dots. I was like, oh, that's interesting. What is that? What is it showing me? And I was like, all right, what did I select? And, what's on the scales? What's on the axis? And, when you look at something like, oh, that's it, but what is it actually? What is it, what I'm looking at? So I figured that out, and I started to play with it. And I thought, you know what? It's already pretty cool information to see where the dots are. But it would be way more interesting if I could see where they were and how they were moving through that scatter plot. So I programmed in VBA basically the next plot, and there was, talking about spaghetti code, I had like thousands of lines of Visual Basic code. And I could give all of that to you, and you look at it as like, oh, thanks, Julius. That's not cool. I was doing, if I change B2 into that value, and then I have to AA12 needs to be that, and then it kind of works. So I had that, and I could actually plot 2 observations for every sector, which allowed me to see where it was moving from last week to this week. Mm-hmm. So, okay. And I even managed to have the current week in a very bright color and then the previous week in the same color but dimmed. So I was very proud of myself that I managed to do that. Started working with that. And then at that time, David Keller, who you all know, was a managing director of research technicals at Fidelity in Boston. And he was one of my clients. The Fidelity team was a client, and Dave was my client. And I, as you do as an analyst with kind of sales responsibility, you call your clients just to catch up and see what's going on. So in one of these calls, I was chatting with Dave, and all of a sudden he said, "Hey, Julius, the last page of your report, I always print that out." And that was, at that time, PDF reports with charts and stuff. And the last page was, I think it's the vintage form of an RRG right now, because it had that plot with the 2 observations. So he says, "I print that out." I said, "Dave, why you do that? You got a PDF, you can read it." I said, No. When I collect them over time, I stick them on the wall, and then over time I have a stack of them. And then remember when you were in high school and you were bored and you had a notebook and you were writing these little doodlemans, like the circle and the thing, and then on every page. So the man would start to walk across the page, and he said, when I do that, I can actually see the rotation. Cool. I thought, wow, that's interesting. So that's when we developed the rotational aspect and the interactive movement through history. So Dave was pretty instrumental. He knows it. Actually, he knows this story.
Dave is independent right?
He's independent. Yeah, he's got his market misbehavior website and tools. He uses RRG as well. So,
but that's a good friend. That's really cool though, because Fidelity's got the big chart room and they have all those charts.
They do.
For sure, they have the relative rotation charts out there. That's cool.
But you know what?
I tell you.
Go ahead.
I tell you that when Dave was there in the chart room in Boston, they installed, I think it was 180-inch screen,
wow,
wall filling.
Wow.
And in that chart room, it's a little bit like a war room. So they got this gigantic screen. It's like seriously big. And they got like a half moon, like a class U form setting with desks with touch screens. And then every analyst goes there and they can throw their stuff on that big screen and discuss.
Wow.
It. So when that screen was installed, I visited them, and we would have an RRG on that massive screen over there. That's very impressive.
That is cool.
That's awesome. So I went there a long time ago before they had that. It was just like printed them out on the special printing paper.
They're still there. Yeah.
So
they're still there.
I was going to tell a little story because it's similar to the one you told about Dave. I'm old school as well. My background is in financial economics, but I remember the days I would print stuff off and look at the hard copy, and I would hold 2 series up to the light to see if there was a pattern or relationship or inverse correlation. That's kind of my little experimentation. But I don't know if you realize this, but maybe 15, 20 years ago, I first saw, I call them snail trails on the OECD website, but they used it for their composite leading indices showing the change and kind of evolution of country momentum in that same quadrant or framework, but it was for economic growth. And then the first time I saw it applied to stocks was with Jim. And exactly to your point, Julius, I thought it was such a great visualization. I put it in our Outlook in January for clients to see the snails. I put the snails in there, and it looks really cool.
Yeah. Yeah, I actually have a few RIAs because you guys are RIAs, right? So you have your clients, you have your portfolios, and you need to do your reporting. You need to talk to these people. And from my experience with reporting, that's super boring. You got a book, and you got all the positions and the prices and maybe some returns, but it's a table, maybe with a little graph with the performance, and that's about it. So I started to work with RIAs to help them make it a little bit more, entertaining or informative using RRGs. And you may have seen RRGs, which we do with bubbles. So instead of the dots on the tail, we use bubbles.
Yep.
And the bubbles, you can put in information, whatever you like. I started using it for market capitalization.
That's right.
So imagine the 11 sectors, but instead of the same dots, the last dot is now the market capitalization of the sector. So you will have technology as a real big bubble.
Huge.
And then utilities and energy are really small, and
real estate
discretionary
small,
is decent size.
Yep.
Healthcare is decent size. But it allows you to see the impact of a sector, or the market cap of a sector.
Yeah.
Now imagine your client portfolios, all the instruments that are in the portfolio on an RRG, and the bubble is the weight of that position in the portfolio against the benchmark. All of a sudden, you immediately can see how important the position is and how it responds and how it drives the performance of your portfolio. So I always say, when everything's inside the leading quadrant, that's fine. You can stay home. But when it starts to move to weakening or rolls over into lagging, then you need to come into the office and actually, start to do some work. Or, if the big ones are still in leading and it's a small one that's in lagging, that's not so much of a problem. But if the big one starts to move, then we need to think about what we're going to do.
Yeah.
And it helps it brings up the conversation. It helps them to engage in the conversation, because it's, if the person who explains or discusses the report explains what it actually visualizes, and that's like a 3-minute job. And, once they've heard it, the next quarter, they will understand what's happening and they will ask for that graph, like, hey, how is that doing? How is it doing? And it brings up a conversation, which is much more fun than just a couple of lines with percentages.
Well, that's a really great point. I'm glad you mentioned that, just because with the S&P 500, how it is now, and even if you look at the Russell 1000 or Russell 3000, NVIDIA is roughly 8%. 8%. And so, we always tell our advisors, like, we focus on diversification, but it's not just diversification, it's position sizing. And we a lot of our models that are quant driven, that use trend and momentum, we will cap it to 2.2%. We let the winners run, but like, it's really important, I think, especially at this stage, to educate advisors and for advisors to educate clients that look, if something bad does happen to one of these companies, and you got a big bubble on the chart. If it's in the doghouse, so you got to be aware of that, to be diversified and just try to protect the downside.
Yeah, but it's also on the other side. If you technology obviously is the pink elephant in the room.
Yeah.
If you say, like, oh, we do diversification, and I started a model portfolio about a year ago based on the best 5 sectors. I blogged it. I wrote about it. Equal weight. So the best 5 sectors, equal weight.
Equal weight. Interesting.
So 5 times 20%. And I did a back test, and over time that gives pretty good results. But the problem with that, which I already signaled when I started writing the blogs, actually is the same conference in Tampa. Somebody was talking about their models, and they were equal weight and how they would weight that. Mm-hmm. And I was in the audience, and I thought, all right, so are you aware that when you allocate to technology, when technology is part of your portfolio and you allocate 20%, that you're underweight technology for, like, at that time it was 35% or 30-something%. So you're underweight by 10-15%.
Yeah.
So even if technology moves, you're behind the wagon. You're not going to catch it.
Tracking error.
So I thought, put your money where your mouth is. So I basically started writing about it, and I run a little money on it myself. I had my own strategy based on RRGs, which I was working on at the time. And it's with when you do testing strategies. You find something that's really well, and then you don't have an immediate use case, and you park it and you stick it on the shelf, and it doesn't come off and it's never get used. So I thought, this time I had a strategy based on RGs, which is basically combining daily and weekly values together to come up with a ranking. I tested it. It was good. I said, I'm going to write about it every week, and I'm going to update that ranking, and I'm going to run an equal weight portfolio, 5 positions, best 5 sectors, 20% each, knowing very well that I will be underweight technology when it happens. So I track it over time. In the beginning, it went pretty good. And then, when the market started to rally in April, tech took off thing. And so from April on, right now, that's the cap weighted portfolio. Sorry, the equal weight portfolio is lagging the S&P by about 11%. So it's a disaster.
Yeah.
Basically because technology was so well. And even though technology was in my portfolio, I was still...
You're so underweight.
So underweight.
Yeah.
So then I thought, I need to change this. But how am I going to come up with a rule that, because you can't say I'm going to overweight every sector with 2% or with 5%, because you have, in the end of the day, you have to come up with 100 at the end.
Sure.
So it totally depends
leverage.
which. That's another possibility, but it totally depends on which 5 sectors are in your portfolio. If technology is in there and discretionary is in there and financials are in there, that portfolio is like 70 something percent of the S&P. So you don't have a lot of percentage points to distribute over those 5 sectors.
Sure.
If technology and discretionary are not in the portfolio, you have a hell of a lot more money to allocate to overweight those things. So I came up with a little rule on how to do that. So I calculate the total weight of the top 5 for that period. And then all of a sudden, so say it comes out at 65%. So that 65% now is 100. So if technology is in there, instead of 35 over 100, which is 35%, if it's like capital weight in the S&P, now it's 35% over 65. So it's 35 over 65. So all of a sudden, it's more than 50% of the portfolio is technology, and that's and now you have the proper attribution for the technology sector. So then, when technology starts to run, you actually profit from it, and it doesn't damage you. And I reconciled the entire portfolio back to the start of the year, and based on that weighting scheme, the performance is now almost 1% over the S&P 500. So for me, that was a very good exercise because it forced me to actually do the exercise every week and not, this is how it went. And, you look at one of those graphs like, oh, it's really nice. But if you every week you have to write, oh, the portfolio is now 5% behind the benchmark. Oh, the portfolio is now 8%. That starts to hurt. Yeah. So you start to come up with how you can do it. So I'm now tracking that. And I just 2 days ago embarked on a journey because I only have the data from the start of the year because that's when I started writing about it. So I embarked on a journey to actually do it back to 2000. So got the reconciliation every week back to 2000 and then apply that same cap weighted rule on those positions to see how it actually in a more real life situation would have worked.
Yeah.
Because to your story, 8% is NVIDIA, even if you have 3% of your portfolio in NVIDIA, which is, I don't know how heavy and aggressively you weight, but maybe 5% for one stock is probably very aggressive. You're still underweight.
Yeah. It's true.
So
and then you have to figure out where do you put the other pieces, right?
Exactly.
So that you're not that underweight technology. I like your example there. And that makes me think of talking to some of the fund managers that are like, they're deep value managers that all they do is deep value, and it is hard. Tracking error is so hard, especially when you get this momentum. And if you're almost in an anti-momentum type of portfolio, you could be waiting a long time until
you're gonna get killed.
You're gonna get killed, and then you might have a short period where everything goes down and you're just down less. So
yeah, well, that's your 2 minutes of fame, so to say.
Yeah.
Actually, it's interesting that we have this discussion, because so many people, especially from the technical side, they are so focused on the entry, like what the buy signal or the trading rule or whatever, but they don't care, or they maybe they don't think it's important, or they don't know it's important. Like, now you have your buy signal. Now what? How much percent of your portfolio are you going to risk?
Yeah.
Is it, so lots of more questions. And I wrote an article about it a long time ago for Stock Charts, and the title was between brackets technical, because I don't think it applies only to technical. It applies to all forms of analysis. So between brackets, technical analysis and portfolio construction are two different animals in the same zoo.
Yeah, interesting.
And it's my experience from last year with that cap weighted versus equal weight portfolio is so on the mark with this. The simple fact of applying the proper weighting scheme to the exact same positions in your portfolio is about 13% in performance. That's a lot.
That is a lot.
I think it's a lot.
That is a lot
over a year. So from going underwater 12%, you're now outperforming by 1% just by changing the weighting scheme.
Julius, that sounds like a really nice, exciting enhancement to RRG. Have you done any work with machine learning and AI? Like, what's next?
Not enough yet, and I don't know what is next. It'll come. There are many things still to be learned on RRG. I have a ton of more ideas. I also, there's more and more interest of companies like Bloomberg and Stock Charts and Optima and what have you, to get RRGs on their website, and that's for RRG research. That's the main goal, to get as many eyeballs and as many RRGs out there, properly licensed, I have to say. But luckily enough, most of the time people are appreciative of that, so that's all good. And then the portfolio construction tool, or the best 5 sectors, I actually started working on that because I was approached by an ETF manager who asked for, said, can you think about an ETF that does sector rotation ETF? So that's how I basically started this journey. So maybe, I don't know where we are on that path, but I've learned the importance of weighting, the fact that the combination of daily and weekly actually adds value. Depends on how you're going to apply it to your portfolio, whether it's going to be very successful or less successful. So in that space, I think I would love to work with more people, like in the ETF space or the portfolio management space, to actually use RRG as an input or rules-based system around RRG, something like that. And that could be for sectors, it could be for asset allocation.
Yeah.
One of the things that I'm working on with Matthew is because that best 5 thing on sectors does very well if you do it over longer time with equal weight. If you take the best 5 stocks in a sector, that's blowing things out of the water, I tell you. If you have the best 5, if you use that same rule set, combining daily and weekly on the individual stocks in a sector compared to their sector index, that is a completely different ballgame. Also in terms of volatility, because you will get larger drawdowns because you're trading individual stocks.
Sure.
But the results are good. So my next goal is to, instead of trading the sector spiders, use that analysis. So best 5 sectors right now, it's healthcare, tech, utilities, communication services, and energy as of this week. go into each of these sectors, take the best 5 stocks in that sector and build a portfolio of the best 5 stocks, 4% each. So you got 25 stocks diversified over the best 5 sectors, 4% in each stock. I don't have the results yet, but I think that'll be a really good. And then you got a little bit more broader diversified because 25 positions spread out over the sectors, and using the weighting scheme at the sector level. So if that you would weight the stocks accordingly to that. But so that's the kind of stuff that I'm toying around with and playing around with, and hopefully find something new to tell with people to share with people.
That sounds really interesting. Let us know how it works.
Yeah,
sure. A lot of interesting ETFs out there, and I feel like that would be complementary to a lot of portfolios because you're going to get totally different stocks than you would in like an index or semi-index type of strategy.
Yeah. Oh yeah, absolutely. Yeah.
Well, this has been fantastic, Julius. I want to thank you for joining us as a guest on the show.
Yeah, it's my pleasure. I love it. It's great talking with you guys.
Hers and his, Three's Company too. Come and dance on our floor. Take a step that is